Well, greetings and welcome to the September 2025 Investment Strategy Brief. Sometimes when we're thinking about what to cover in some of these sessions, I talk to the team and I ask the question, well, what's the question or questions that clients are asking right now? And as the markets have just driven higher, the clients are asking the question, can positive markets move even higher from here? So that's sort of an extension of our last conversation in a way, but I want to get into sort of things that have been driving the market a little bit higher, some of the risks we see out there, and where we think things are going from here. So let's jump into it. I'd like to start with politics and geopolitics. So we all know that there have been massive shifts in DC, lots of policy changes, a lot of focus on sort of the fiscal side and tax policy, especially tariffs and trade policy. And everyone's navigating really what has been the uncertainty of all of that. But one of the things that did get done, as we talked about last time, was the passage of the One Big Beautiful Bill Act. And while there were all kinds of different changes, the punchlines really included that the tax cuts were made permanent, some other tax relief was made available. Ultimately, that is essentially positive for the economy. And so, there's an estimate that this is just supporting things a little bit. So one of the factors, anyway, you can think about is just with the expectation of slightly lower tax bills, both individuals and businesses might be spending more broadly. So moving to the geopolitical side of things, as we've talked about before, we have a dashboard where we're monitoring all kinds of risks. We're watching U.S.-China interaction. We're watching for, things that could occur, but most notably, of course, the military hotspots, and that includes Israel, Iran. It includes, of course, Russia, Ukraine. And things seem a little edgy, right? And so once again, while we watch that more generally, we're mindful that any sort of buildup in action can be taken negatively and ultimately cause markets to turn south. Moving to the economy, the economy has held up. We started the year talking about positive but slower growth, and that's sort of how it's unfolding. Remember that the consumer makes up over 2/3 of the economy, but ultimately we're back to that longer-term trend line. And when it comes to that driving force of the consumer, we've been monitoring, as we've talked about before, things like retail sales. And while it's a little bit of a volatile series, we can see, generally speaking, that retail sales has been positive, and most recent prints sort of play that out. Now, this is against the backdrop of slightly higher interest rates on debt, for example, and then what has been a very good job market that's softening. And so, the punchline here, as we looked at last time, as we tried to look at data sort of before the pandemic, what was normal back then. We looked at sort of the strength of the reopening after the pandemic, and then the blue bars here represent the current data. And the punchline is, even though things have softened a little bit, unemployment rate, jobless claims, the JOLTS job openings, these are all positive numbers compared to sort of normalcy before the pandemic. But the data that has everybody a little bit wondering is the non-farm payrolls that have really softened, and it's both the monthly data and a revision to the data looking back. All of that's just not quite as good as what folks thought. So you're going to hear people talking about the idea that the labor market's softening a little bit, and that is important, right? That could be signaling a slowdown. But ultimately, folks are still forecasting, think of it as 1.5% to 2% growth for 2025, and a continued positive growth into next year for sure. And so ultimately, this is something that we're monitoring as it relates, for example, to Fed policy. So the other dimension of that, of course, is inflation. People have been worried about tariffs negatively influencing inflation, but the punchline there is, in fact, if you look to the far right of this chart, and I'll explain it again, we're looking for inflation data to cool down to be around the Fed's 2% target. The green line, these are monthly numbers, but that represents the monthly equivalent of the Fed's 2% target. And you can look back a few years and see that inflation was really a bit out of hand. Now, when we look here, each of these bars is a 3-month rolling average. The darker blue are CPI, the Consumer Price Index, and then the gray is the PPI, the Producer Price Index. And the punchline here is that while things are moving around a little bit, and maybe CPI, the latest report, was a little bit firm, it's really kind of gotten down very close to the Fed's 2% target, let's call it, for the last 6 months. And so it's not like the Fed's saying, oh, we're done. But when they're looking at the balance of risks between inflation and jobs, they're now focused on the softening job market. And in fact, at this September meeting, they cut rates 1/4 of a point. This chart's been updated to look back at the recent history and then look forward in terms of the Fed Funds futures forecasts. And so what you can see is we've now seen them in this cut cycle, which has gone back a while. It's basically 1 1/4 points that have been reduced from the highest level of the Fed's fund target in this most recent cycle for the Fed. And then as we look forward, the market's pricing in 2 more cuts this year and then a few more next year. And interestingly, when we look at there's things like the balance sheet. This has gotten better. Remember that they grew their balance sheet as another element of support. But then when we look at the Summary of Economic Projections, what's called the SEP, interestingly, we see a few things. We see the Fed basically suggesting that maybe the labor market's going to weaken a little bit more. We basically see them baking in, and this is the median forecast of all the officials. It's basically each individual forecast, and then the SEP includes sort of an analysis of the median. But the punchline is that median is reflecting the 2 cuts for the balance of the year. And so it's almost like the Fed's expectations have come somewhat into line with what the market is expecting. And, in the various communications, the statement, the press conference afterwards, the Fed definitely, and Chair Powell definitely talked about this balance of risks between inflation and the labor market. And kind of what they're signaling is neither are perfect, but right now they feel they need to turn their attention just a little bit more to the weakening labor market and therefore the 1/4 point cut. And I think they described it as a defensive cut. So anyway, obviously people have been waiting for that, and there's an anticipation of more. I will say this, that one of the things the market tends to do is to overestimate Fed cuts. So they're expecting more, the market's reflecting that investors are expecting more, and then the Fed doesn't cut. And that's a factor as it relates to this elevated market levels, which we'll look at in just a second. But basically, if the Fed disappoints, that can be another catalyst that could drive the market back lower. Another thing that we're keeping an eye on, as we talk about a lot, is this fiscal trajectory of the U.S. government, basically spending more than we take in, building up our debt. With interest rates elevated, that means the cost of debt is going up. So this continues to be something that we're very focused on over the medium term. And as we watch interest rates, especially longer term interest rates, we think this idea of a little bit more worry around sort of the creditworthiness of the U.S. government has sort of caused investors to demand a slightly higher yield on the bonds that they buy that are longer term. And that brings us a little bit to the market. So looking at yields, what's been interesting is that the longer term rates have stayed somewhat elevated, but at the short and medium term, the market's anticipating these Fed cuts. And so the market rates are starting to come down. Now, a lot of things that we see, mortgages, credit cards, these are anchored more, sometimes more on market rates. And so this could end up spelling relief. And again, the question is the market reacting appropriately, or is it overreacting to this Fed activity and the prospect of more cuts looking forward? Now, as it relates to these still elevated yields, we know as bond investors, it means that various categories of bonds remain attractive. And so we've seen, again, sort of return to the bond market when it comes to our clients and how they're investing. Now, turning to the equity market, as we've done before, I wanted to kind of show this chart, which is the first year of a presidential term, the blue line representing the long-term average, the orange line representing Trump 1.0, and the gray line being this year, so the Trump administration 2.0. And notably, that first line, sort of in the middle, the orangish line, that was our year-end target as we started the year. That we went through that on June 30th. We republished, which we'll revisit here in a second, a revised target of 6,500. We recently went through that. And so the market, and again, the topic of today's session, just keeps going higher. And in fact, when we look at valuation levels on a PE-related basis, cap-weighted, the market appears to be 25% overvalued. But now we've talked about the idea that growth has been enhanced. And really, when it comes to sort of corporate activity, one of the reasons the market's gone up, and it might be sustained here, is the idea that companies, generally speaking, are healthy. They're basically having improved profits and expected to be more improved earnings growth. And those are both things that investors like, right? So when you're looking at growth and you're looking at profitability getting better, that sort of can result in a higher PE multiple. So those are some of the factors that are essentially driving markets higher. Now, one thing I did want to point out, we're in a positive environment month to date in September, but the reality is when we look at the averages, and this happens to look back over the last 80 years, and we look at each month and how each month does, on average, September is kind of a negative month. And it's more than half the time that the months are negative in September. So while it's a little bit positive, it wouldn't surprise us at all if we saw some volatility and some negative volatility from here. And so, we have to be ready, if you will, for a slight change. And, what I would say is that the overall market has been strong. When we look back to the weakness in April, from Liberation Day and the unexpected announcement on tariffs, the majority of indices have basically recovered. All these check marks here on page 25 show us that the various categories, most of them, have recovered from the lows hit or from the peak prior to the move down. And, at the end of the day, with all this data is showing us is that the market has had another good year is the punchline. And so, we've got more time to go for sure, but it's been a generally positive market. And to revisit that second half outlook, so we've talked about, sort of improvement in understanding what's been going on with the tariff policy, inflation cooling down a bit, as I mentioned, maybe a softening but still solid labor market, the Fed cutting at least a couple of times perhaps, positive economic growth is represented by GDP, and then that earnings growth that we visited. We had said, hey, let's assume for the balance of the year that the S&P, since it surpassed 6,200, it could get to 6,500. We're a little bit above that now. And so people are going to ask, well, what does that mean? And to me, what that tells me is that, the market could pause a little bit. It's not that we're worried, and we're not telling people, we're not tactical allocators where we say pull your money out of the market, but anything that could sort of shake the market, a little bit more uncertainty on policy, any evidence that inflation is reaccelerating, maybe evidence that the consumer backs away a little bit, a geopolitical conflict, anything like that, especially could cause the market to sort of slow or turn negative a little bit. But again, overall, the fundamentals actually have remained pretty strong. Now, one of the factors that we'll probably spend more time in future episodes that's sort of been very supportive is the strength of the use of artificial intelligence. And so in our weekly series, we call it Sightlines, we've actually done, or weekly articles, we've done a series on artificial intelligence, talking about the impact on the labor market, talking about how we're going to start as investors analyzing essentially where to look for the benefits of AI and the results that companies post. And then we're going to do a couple of different sort of sector and industry zooms. One most recently is looking at healthcare and how AI is making a difference in healthcare. But saying it more generally, in all the research we've done and experts we've talked to, the idea that artificial intelligence is here and real is spot on, meaning as you look at various companies, given that these tools are hitting the market so quickly, essentially a lot of what's being focused on is how are you using these capabilities to improve what you do. It might be the way you operate your business. It might be the offering that you have and injecting some AI into that. But we think it's super important to kind of dig into that and understand how AI is making a difference. And it really is. That's sort of the punchline. And we view that as sort of one element of our medium to long-term themes as a real positive, right? This is ultimately a tool, kind of like the internet, kind of like mobile computing, where it's going to really change and improve productivity. But the observation is it's happening a lot faster than those other two examples. The internet and mobile computing actually happened. The internet, for example, might have been a decade for it to kind of get set up and for it to start to really make a difference. But, AI is basically making a difference today. So anyway, those are the things we wanted to cover. So think of it as, celebrating positive markets, recognizing they're a little richly valued. There's optimism around AI. There's optimism around company performance. But ultimately, we have to be mindful that different events or news or whatever could cause a little bit of volatility, a little bit of negative volatility. And for long-term investors, that just means stay the course if you see that happen. As I sometimes do, I'll just kind of finish up by inviting you to check out stiefelinsights.com. It's our website hosting this kind of work and a bunch of other things. So invite you to check that out. And with that, I just want to say thanks for joining, and we'll see you in October.